Welcome back to the special edition of Indianomics. We are calling State of the Economy. The economy has been deluged with a lot of numbers. There has been a new series of wholesale price index and industrial output data. New series because the base year has been changed from 2004-05 to 2011-12. This has made the wholesale price index numbers look a little lower than in the old series, and the industrial output is a little better than it was in the old series. In fact, much better. Another set of numbers that came out on Friday are the consumer price inflation numbers for the month of April, and they are eye-popping because we have a number of 2.99% for the month of April, a historic low since the new series started. I have with me Dr. D.K. Joshi, the Chief Economist at CRISIL, perhaps, and former Chief Statistician of India, and Soumya Kanti Ghosh, the Chief Economist of State Bank of India. Well, Soumya, to you first, what will be the first half of inflation look like if this sub-3 number is going to continue? The Reserve Bank's earlier indication was that the first half would be between 4 and 4.5. What's your guess?
See, I think if we get the way at 2.99% and the way the prices have been moving in terms of the current month trend also, we are expecting that the next couple of months could be sub 3% inflation number, and the first half average, which is around 4 to 4.5% as said by RBI, is going to be clearly materially undershot. And I will not be surprised if the average is closer to the 3.5% in the first half, 3.5 to around 3.6%. So in that case, I think the whole year average, and even if we are assuming the fact that the second half could be a little worse in terms of the inflation numbers, maybe 4.5% onwards. So the whole year average could be now closer to 4.5%. So that in itself will be a pleasant surprise as far as the CPI the trajectory goes.
Okay. Mr. Joshi, your thoughts? What's your trajectory?
Well, I think our current forecast for the full fiscal year was 5.5%, and I think we now see, because this was a surprise to us also, we see some downward bias to that. But I think overall the first half below 4%, and I think the second half closer to 5%.
Okay. Well, Dr. Sen, you have been the chair of our Citizens Monetary Policy Committee as well. We haven't seen this kind of a 2.99 number, and Soumya, who follows these numbers very closely, believes that we are going to see this continue for a few months now. Dr. Joshi also agrees that to his number there is a danger of a downward bias. Given that, do you think the Reserve Bank tightened its stance a bit too quickly?
You know, I don't really have a problem with the Reserve Bank moving to neutral from accommodative. My problem was that I had thought that they should actually cut rates and move to a neutral, rather than freeze and go to neutral. Okay. So it just depends upon how you're strategizing the future. I mean, that's a call that they have to take. Okay.
But is your...
But you need to be a little careful, Lata.
Yes.
You need to be a little careful. And that is that what we are seeing now is a major base effect playing out. So I tend to agree with Soumya that we are seeing a base effect playing out. What you really need to have a fix on is the momentum. And I am not sure whether the kind of corrections that we are making for seasonal factors, whether they remain valid. Because the seasonal factors have been changing over the last couple of years.
Okay. Well, point taken. Dr. Joshi, very quickly, what's your sense about the GDP and the inflation inflation you gave me? What's your sense of the GDP for the current year to finish the output argument? Are you getting a sense that we could be surprised on the positive?
Yeah, I think our estimate is 7.4% because the last year was a little depression because of demonetization, and I think this year you're getting remonetized. So clearly that's going to inflate the economy. And I think with the WPI also staying soft, so the deflator will also work in favor. So I think overall I would say our forecast is 7.4%, and I think even after the revision of the numbers, we maintain that forecast.
Okay, very quickly, Soumya. Very quickly, Soumya, you think yields could go lower? Could the actual borrowing cost for industry go down because of the sentimental impact of this inflation and even real impact?
No, there is a possibility, because if you look at the market reaction today in terms of the new 10-year paper and the way the market was rallying even before the data was released, so there was a sense of anticipation in the market that possibly the inflation number could surprise on the downside. So yes, there is an element of hope in the market that these inflation numbers could have some sort of positive impact on the yields. So from that, to that point of view, at least the yields will not have a significant upward buzz as of now, and it should move down. And the extent of moving down, one could debate on the what pace it could move down, but there should be a definite downward bias to the yield movements.
Oh, absolutely. And considering that even the Reserve Bank expects that because of GST, in the current year, the fiscal deficit of the states is going to fall to 2.6%. If that were indeed to be realized, I think we have a perfect combination for lower fiscal deficit, lower inflation, and probably therefore better macros and better output. Dr. Sen, DK Joshi and Soumyakanti Ghosh, thank you very much for joining me in this discussion. The key takeaways from our experts is, because the new series is indicating a slightly lower wholesale price index inflation, there is a chance that real GDP growth for FY17, for the year that just ended, could be slightly revised higher. Even the previous years would be revised higher. That's one takeaway. The second takeaway is that for the current year, prices are definitely undershooting, and that's going to be positive for the cost of money, for interest rates, for the rate at which industry will borrow. So two very good takeaways for the macro economy from the Central Statistical Organization. That's it on this special edition of State of the Economy. Thanks for watching.